Today I will discuss about some important multiple choice questions and case studies of financial management and financial market. Question 1 is the primary goal of financial management is. The answer is A. Primary goal means the main important goal, the most important goal. The most important goal of financial management is to maximize the wealth of shareholders. They must get, the shareholders have invested their money and they should get better dividend, maximum dividend, and the price value, the market value of the shares must also increase. The second question is financial management is concerned with. Now, financial management is to decide how much money is required, how to raise the required money, how to use the available resources in the best possible way, and how to allocate the money raised to optimize the wealth of the company. So we can say the answer is D, that is all the above. The third question is which of the following is not a capital decision? Not a capital decision. Capital decision always increases the profit earning capacity of the business. So here the first three options, that is purchase of new fixed asset, opening a new branch, launch of a new product line, increases the profit earning capacity of the business. Whereas investment in inventories, that is purchase of raw material, does not increase the profit earning capacity of the business directly. So the answer is D. The fourth question is justify debt is more risky as compared to equity. Debt means borrowed capital. Borrowed capital means taking a loan from bank or any other financial institution where you have to pay the interest as well as the principal amount. It increases the financial burden on the company. Whereas equity is a kind of permanent capital. On equity, only dividend is to be paid to the shareholders, and that too depending upon the profits. It does not increase any kind of financial burden on the business. So we can say debt is more risky as compared to equity. The answer here is A, agree. Question number 5 is the inability of a business to meet its fixed financial obligations like payment of interest is known as. Here it is talking about financial obligations. So financial obligations means related with money. So that is a kind of financial risk. So we can say the answer is B, that is financial risk. Question number 6 is a decision to acquire a new and modern plant to upgrade an old one is known as dash decision. Here the answer is investment decision, because the business is going to invest a big amount of money on purchase of new plant and machinery, which is going to increase the profit earning capacity of the business. So this is an investment decision. Question 7 is ABC Limited has debt equity ratio of 3:1, whereas XYZ Limited has debt equity ratio of 1:1. So you have to name the advantage ABC Limited will have over XYZ Limited when the rate of interest is lower than rate of return on investment of the company. That is the main clue there. So the answer is A, that is trading on equity. Here the rate of interest is lower than the rate of return on investments. So the rate of interest on borrowed capital what they have to pay is less than the rate of investment, the return on investment what they are getting. So they can maximize the wealth of the shareholders. Question number 8 is which of the following is a tangible asset? So definitely tangible means what we can see, what we can touch, what we can use. So plant and machinery is the answer. The other three, that is trademark, goodwill and patents, are intangible assets of any business. In question number 9, the finance manager Mr. Chetan is trying to increase the market value of capital invested, and by which he is trying to maximize the wealth of the shareholders. So here the answer is wealth maximization. In question number 10, we can see that the company is making profit for last many years, and again they have to declare dividend this year. Again, one more thing is given, that is that the company wants to increase its profit by 20%. So here the answer is stability of earnings. The question is asked, which component affects the dividend decision? If company increases profits, definitely the stability of earnings will get changed, and as a result the dividend decision will be affected. In question number 11, the opening of a new branch is an example of which type of decision? That is actually investment decision, but investment decision is not given in the options. So financing decision is the most befitting answer. So answer is financing decision. Question number 12 is dash is a type of financial decision. So here you see financial decision consists of three type of decisions, that is investment decision, dividend decision and financing decision. So the answer is all of these. Question number 13 is excess of current assets over current liabilities is known as, it is working capital, because current assets minus current liabilities will give us working capital. Question number 14 is Alicia Limited manufacturing ice creams wants to increase the scale of production during summers. Here it means that they want to increase the production of ice creams. So here the answer is more. They have to increase the production of ice creams more. Question number 15 is dash is not included in the owner's capital. Owner's capital is also known as permanent capital. Now what is owner's capital? Equity share capital, preference share capital and retained earnings. What is not to be returned in a short period of time or in the due course of time is known as owner's capital. So here the answer is long-term debt, that is B. Long-term debt is a borrowed capital and that is not owner's capital. Question number 16 is which of the following statement is incorrect regarding dividend? Here we need to understand what is dividend. Dividend is the portion of the profit what is given to the shareholders for the money what they have invested through equity or preference shares. So now here option C is the answer, because portion of earnings that will be distributed to owners is wrong. That is portion of profit that will be distributed to the owners. The other three options are not at all connected with dividend, so they are not to be considered. Question number 17 is financial leverage is unfavorable when the condition we have to see. So we need to understand what is financial leverage. Financial leverage is the use of borrowed money, that is debt, to finance the purchase of assets with an expectation that the income from new asset will exceed the cost of borrowing. Means the return on investment is more than the cost or the interest what you are paying on borrowing. Then that is a favorable condition. But in the question it is said that unfavorable condition. So unfavorable condition is option A, when return on investment is lower than the cost of debt. Question number 18 is financial decisions impact which of the following items of profit and loss account. Here we can see interest, tax, profit. I think all the three are influenced by the financial decisions. If you borrow more money, you have to pay more interest and less tax. If you borrow less money, you have to pay less interest and more tax. And definitely by this, the profit will also be affected. So the answer is D here, that is all the above. I gave two case studies here. You need to read the case studies very properly. Read the given paragraph at least 2 or 3 times. See the questions, what is given. Don't try to find the answers from the paragraph itself. Sometimes the answers may be from outside the paragraph also, but connected in some way or the other way to the paragraph. So here the most important advice is read the questions first, then you read the paragraph. that will help you in finding out or analyzing the answers in a very proper way. Now let us see some questions of financial market. Here the first question is, it is a market for short-term funds which deals in monetary assets whose period of maturity is up to 1 year. This is very important. Maturity period is 1 year, less than 1 year only. So when we talk about financial market, this financial market is divided into two parts. One is called your capital market, other is called your money market. Capital market is again consisting of two types, that is primary market and secondary market. The second type what I was talking about is money market. Money market is the short term instrument market. So that is the market for short term. So here the answer is money market. In money market we can find short term funds, short term money market instruments are available whose maturity period is less than 1 year. The second question is, which of the following statements is not true with regard to treasury bills? Now here we need to understand what are treasury bills. The treasury bill is a short-term government security, usually of duration less than 1 year. Its maturity period is generally less than 1 year. It is sold by the central bank on behalf of the government. So definitely these are issued by the government. So they are highly secured. Treasury bills are issued at a price which is lower than the face value and repaid at par. So here the answer is option C. They carry high risk of default. That is a wrong statement. Here question number 3 is, suppose an investor purchases a 91 days treasury bill with a face value 2 lakh for rupees 1,92,000. By holding the bill until maturity date, the investor receives 2 lakh. What is the amount of interest received by him? Here the rule is, treasury bills are issued at a price which is lower than the face value and repaid at par. So that is 2 lakh minus 1,92,000, he will get the interest of 8,000 rupees. That is the benefit of the purchaser. Question number 4 is, which of the following statements is not true with regard to commercial paper? Commercial paper is a short-term money market instrument which has got a maturity period less than 1 year. So the answer is A, which is a wrong statement regarding to commercial paper. Question number 5 is asking, what will be the impact of rise in call money rates over the short-term money market instruments like commercial paper and certificates of deposit? Here we need to understand what is call money. Call money is a short-term money market instrument through which one bank may borrow money from another bank to maintain its reserve ratio as per the guidelines of RBI. So when one bank borrow money from other bank to meet their cash requirements, liquidity requirements, that rate of interest what one bank pay to other bank is called call money rates. When they borrow money and they pay interest, definitely the lending rate will be higher. So at that time what will happen? The commercial paper and the certificate of deposit will become cheaper in comparison to the funds raised through these sources. So here the answer is B, that is cheaper in comparison with banks who raise funds from these sources. Question number 6 is, it is a short-term negotiable self-liquidating instrument which is used to finance credit sales of firms. Credit sales is always financed by commercial bill. So wherever credit sales we can see, there commercial bill is used. So the answer is commercial bill, A. Question number 7 is, a company can raise capital through the primary market in the form of. The primary market instruments are shares, that is equity shares and preference shares, debentures and bonds. So all these instruments can be issued through primary market. So the answer is D, all of the above. Question number 8 is, which of the following statements is not true with regard to capital market? Capital market always deal with long-term funds. So here in this question the answer is A, which is not true. That is, the funds are raised for a short period of time. This statement is not true with regard to capital market. So the answer is A. Question number 9 is, which of the following participants represents capital market? Here the answer is D, all of the above. Because development banks, commercial banks, stock exchanges, all are the players of capital market. They participate in capital market. So the answer is D. Question number 10 is, the stock exchange works as a mechanism for valuation of securities through the forces of demand and supply. So here you have to identify the related function performed by stock exchange. Valuation of securities means that is the pricing of securities, fixing the price of the securities using the forces of demand and supply. So the answer is C, that is pricing of securities. Question number 11 is, the process of holding shares in electronic form is known as? The answer is B, that is dematerialization. Nowadays all the transactions are recorded in the electronic form, and this is a much safer and secured way of holding the transactions. Question number 12 is, one of the common irregularities noted by the Securities and Exchange Board of India during the inspection of stock exchange was that it was dealing with unregistered sub-brokers. Identify the related function of Securities and Stock Exchange Board of India, SEBI. So now you see under which function this comes. When we talk about the regulatory functions of SEBI, we can see that the registration and regulation of the brokers and sub-brokers and other players in the financial market, that is the main regulatory function of SEBI. So the answer is A, regulatory function. Question number 13 is, it acts like a bank and keeps securities in electronic form on behalf of the investor. Here the answer is B, that is depository. Now, a depository is like a bank, keeps securities in electronic form on behalf of the investors. So depository is the answer. Question number 14 is, it is a legally enforceable document which is used by a stockbroker within 24 hours of the execution of a trade order. Here the answer is C, that is contract note. This contract is a legally enforceable document. Question number 15 is, after the trade has been executed, the broker issues a contract note to the investor within, the answer is 24 hours. Within 24 hours, the broker has to issue a contract note to the investor. That is compulsory. So the answer is 24 hours.